Welcome to this presentation on the Statement of Cash Flows. This financial statement is a critical tool for understanding how cash moves through a business. And today, we'll explore its purpose and importance in financial analysis. By the end of this presentation, you'll be able to explain the role of the Statement of Cash Flows in financial reporting, understand its structure, and the three main categories of cash flow activities, and recognize how this statement connects with other financial statements, like the income statement and balance sheet. In accrual-based accounting, there's an important distinction between revenues and cash. Companies can report revenue when it's earned, not necessarily when cash is received. Similarly, expenses are recorded when incurred, not when paid. This creates a gap between reported profits and actual cash position. The Statement of Cash Flows bridges this gap by showing the actual movement of cash in and out of the business. This statement is crucial for three main reasons. First, it reveals a company's ability to generate cash from operations, which is essential for sustainability. Second, it shows how the company invests its cash in long-term assets and growth opportunities. Third, it demonstrates how the company finances its operations through debt and equity. Together, these insights help stakeholders assess the company's financial health and liquidity. The Statement of Cash Flows can be prepared using two methods, but the indirect method is most commonly used. This approach starts with net income from the income statement and adjusts it for non-cash items and changes in working capital. By reconciling net income to actual cash flow, the indirect method provides a clear picture of how accounting profits translate into cash generation. Cash flows are categorized into three distinct sources. Operating activities represent cash from day-to-day business operations. Investing activities involve the purchase and sale of long-term assets. Financing activities include transactions with creditors and owners, such as borrowing money or issuing stock. Each category tells a different story about how the company manages its cash. Cash flows are categorized into three distinct sources. Operating activities represent cash from day-to-day business operations. Investing activities involve the purchase and sale of long-term assets. Financing activities include transactions with creditors and owners, such as borrowing money or issuing stock. Each category tells a different story about how the company manages its cash. Operating activities are the heart of the cash flow statement. They show cash generated from the company's core business operations, such as selling products or providing services. This section also includes changes in working capital accounts to show where cash flow is being tied up or generated in the day-to-day operation of the business. This section starts with net income from the income statement and then adjusts for non-cash expenses like depreciation. Note that net income is an accrual-based measure of profitability, and we are essentially trying to unravel the items we accrued back into a more cash-like perspective or position. Net income is further adjusted to unravel changes in current assets and liabilities, such as accounts receivable, inventory, and accounts payable. For example, when accounts receivable increases on the balance sheet, it means sales were made on credit, reducing cash flow. Or when inventory increases, this means cash was used to purchase goods and more cash is now tied up in inventory. These adjustments transform accrual-based net income into cash-based operating cash flow. Investing activities reflect how a company allocates cash for long-term growth. This includes purchasing fixed assets like property, plant, and equipment, as well as acquiring long-term financial assets such as stocks or bonds of other companies. When these assets are sold, the proceeds appear as positive cash flow in this section. Investing activities typically show negative cash flow for growing companies that are expanding their asset base. Financing activities show how a company raises capital and returns value to stakeholders. This includes borrowing money through loans or issuing bonds, which brings cash into the business. It also includes repaying debt, issuing new stock, buying back shares, and paying dividends to shareholders. These activities reveal the company's capital structure decisions and its relationship with creditors and investors. The three categories of cash flow combine to show the net change in cash for the period. This net change can be positive, indicating the company generated more cash than it used, or negative, meaning cash decreased. This net change is then added to the beginning cash balance to arrive at the ending cash balance, which must match the cash reported on the balance sheet. The statement of cash flows doesn't exist in isolation. It connects directly to other financial statements. Net income comes from the income statement and serves as the starting point for operating activities. Depreciation expense, also from the income statement, is added back as a non-cash charge. Changes in fixed assets link to the balance sheet and appear in investing activities. Dividends paid connect to retained earnings, and the ending cash balance ties directly to the balance sheet. Let's review what we've covered. The statement of cash flows plays a vital role in financial reporting by showing actual cash movements, not just accounting profits. It's structured into three main sections: operating, investing, and financing activities. Each section provides unique insights into how a company generates and uses cash. Finally, this statement integrates with the income statement and balance sheet, creating a complete picture of financial performance. Understanding the statement of cash flows is essential for anyone analyzing a company's financial health and sustainability.